Hey everybody, hey traders, welcome to a Trading 101 strategy session. I think this is something that I'd like to do on a regular basis, maybe every couple of weeks, maybe at least once a month. Just talk shop, talk the markets, kind of an ask me anything Q&A type session where we can go through, what are the markets doing? What do I see happening over the next, couple of weeks in the next few months? How am I positioning? But I want to use today's session primarily for talking strategies. Up, down, sideways, the market's only going to do that, right? It goes up fast, down fast, up slow, down slow, goes nowhere, goes sideways. But what's crazy is every year is different, right? The markets can go up, down, sideways. And I said this in a previous webinar, it feels like you can do it in like an infinite amount of ways. So it's never easy. If it was always easy, then everyone would be a trader and everyone would just be making heaps of cash. But that's obviously not the case because there's real emotions and there's real money in the markets, and it's not always perfect, right? So let's dive in. Let's have a look at a couple things. All are welcome. This is for traders anywhere between beginner to advanced. There's no discrimination on where you're at. I've got plenty of strategies to teach and discuss, so let's dive into it. P&L on the days looking pretty good. 22,000 on the day, 96 for the year. I'm down from like 195 for the year, so I did, it's really just been a lot of change in option prices. So some of my, cash secured puts and some of my ratio spreads, they've been hit pretty hard. They haven't taken losses yet. They're not realized. So anyway, I'll just be monitoring my levels. I did close up a bunch of hedges this last week, and I closed out more today. So I basically have taken off a lot of my hedge trades. Right now, let's have a quick peek at the market heat map. Hey, Claudio, how are you? Let's take a look at the heat map for today. See what's moving and shaking. We've got about 60% of stocks advancing, 37% declining. You're getting a lift out of Mag 7. You got energy that's down pretty hard today. Let me double check and see. XLE down to 84. I've got 83, 82, 81 puts. Let's see how the energy sector is going to behave. So I do have some puts on XLE. Let's see how that's looking right now. Probably, again, just changing in option prices, taking some heat on it. It's not a sector I don't mind being in XLE. But right now, down about $950 on a couple of accounts. So that's just option prices. I mean, when the dust settles, I don't necessarily have to take on any assignment. I may not take on any assignment. This drop in energy has been pretty swift from $92 down to $84. And this has happened within, 3 trading days. So that might be a bit extreme. If there's any type of bounce or elasticity, or we even have this, channel, if we defend this level around $83 to $84, that's where I ended up selling the premium. So if we end up bouncing off there and stabilizing, then there's probably no assignment risk, and I'll just keep the credit, but I'll just monitor that position. Okay. John says 50 cents. Should I use? No, John. I'm doing the bull put spreads. I'm just gonna let those ride, man. So bull put spread all the way down to 57.05. So 57.05 is right in here. Okay, so I'll keep an eye on it. Basically, what I want to see on that trade is if price is going higher. Let me go back to my trade here. So if price is going higher. This is SPX. This is my, where'd it go? Let's get this one ungrouped. And let's take the ones that remain. There's my 57.05 to 56.95, 57 to 56.90. This one is going to be a bull put combo. So this trade is now trading for about 75 cents. I'm just going to keep the trades running because what price would have to do on the current price around 57.97 is we would have to drop 92 points to threaten my position. Not saying that can't happen, but probability is right now we're trading around a 5 delta. So the probability of this finishing out of the money is about 95%. So I'm not going to micromanage the trade. There's obviously risk in the trade by going 10 wide. And so long story short is I'm just going to let price do its thing today. I think as long as price stays within this range between about 57.50 and let's say even the high side from yesterday's push up towards 58.60, if we stay kind of range bound where this low, this would be a really interesting read on the day because this low, if we have a higher low, look, this might end up being This area from low to high, this may end up giving us a big indecision candle. And that's what we saw on the daily candles yesterday. So if you go to the charts here, go to the daily candle on SPX, SPY, all of them were big indecision candles yesterday, right? So we're still trading in the middle of yesterday's candle. We had a big volatility candle here yesterday. We had a huge move on Monday. And I just think as long as price stays within, then we're fine, right? Lows yesterday around 57.32. My strike is around 57.05. I've got a 200 EMA also around 57. That value is around 57.07 to 57.10. So that's if we took out yesterday's low. If we end up hitting the 200 moving average, I think we've got some wiggle room to let that trade be profitable. Correct. That's right. So if we close above 57.05, we make full credit. That is correct. That is correct. And that is the plan for the trade. So on that note, let's transition this into trading 101 strategy session. Let's go strategy number one. I'm going to focus on let's talk, options a little bit. I trade a lot of options over the last, 4, 5, 6 years. A lot more options in my portfolio. A lot more income generating options. I can kind of go, multi asset classes here, multi tools, but we'll touch upon those. But what I want to get into is I've got a lot of members and followers in my services now that we're trading a lot of options together, and so I want to walk through some very simple core strategies on here's an easy way to trade the market up, easy way to trade the market down, easy way to trade the market sideways. If we focus on that, I think we can all walk away from this session with some understanding of okay, that makes more sense. I take away a lot of the confusion and a lot of the language and a lot of the difficulties with trading options, and I make it very straightforward. This is literally why I have a course called Practical Options, which is available to all my lifetime members in any services that I run. So Practical Options has a full course that I sell online through it. It's an on-demand page through Vimeo. $497 is the entire course. I give this to members for free if you're a lifetime member of any of my services. I also have a quick options course. So quick options would be the same thing. I've got an on-demand page for that. This one's 27 bucks. So I'm essentially talking a little bit about this today. This does, the course today is just strategy session, trading 101, trading up, down, sideways. This course for $27 covers a lot of the same material, but it's on demand. You own it. You can watch it whenever you want. Plus, there's a strategy guide to it. So if interested, you can type in, hey, Chris, I'd like to get your quick options link or get your practical options link. Let me know. I can post those links in the chat. Right. Otherwise, let's get after it. Okay. So let's start with this. Let's talk trade the market bullish strategies. Okay. And again, I'm gonna first approach this from just trading options. Okay. Because obviously if we're trading bullish, like you just buy and hold, right? That's very simple. Buy and hold. That's boring. That's passive. Does it make money in the long run? Sure. Is it perfect? No, because you could have a stock that over a 5-year window goes zero, right? Let's say that you buy a stock. Let's say Palantir is an example. Palantir went from $10 to $20 up to $100+. What if that comes back to 50? What if that comes back down to zero? Right? Or what if it takes all this time? It's like if you didn't time the buy and hold, you don't make any money, right? So buy and hold is you have to have a long-term horizon to buy and hold. You essentially just allocate, and then if you're having a stock that's killing it, you take some of those profits, reallocate. Maybe some of your favorite stocks, your favorite kind of pie chart of how you take your allocations. But buy and hold is look, buy and hold the SPY. Dollar cost average into it. Dollar cost average into it. If it's in a drawdown or if it's up, bull markets or bull markets, bear markets or bear markets. We've seen over 90 plus years the S&P finds a way to go higher. The Dow goes higher. The Nasdaq since the 90s has gone higher. 90s or the Nasdaq is one of the best performing assets in indexes of all time. It's only been around for 30 plus years. It's electronic trading. It's now tech. It's your top 100 tech companies. It comes with a lot more volatility. The nice thing about trading the haystack instead of trading the needle is the best companies that rise to the top allow the Qs to still grow, allow the SPY to still grow, and allow the trends and the positive drift to continue to take place. So buy and hold is very simple, very basic. Anybody can do that. What do you have to worry about with buy and hold? Well, don't run out of money and make sure that you're willing to hold through drawdowns. That's the good and the bad. All right, so we're going to move past that. We're going to get a little bit more strategy specific. Okay, all right, yep, let me post a link here. So here's practical options. So there's practical options. That's the full course link. And then here's the $27 course as well. Quick Options is a $27 link. All right, so we got buy and hold, easy peasy, right? Let's talk option strategies. So this would be buy and hold. That'd be more passive. Let's talk option strategy specifically. Long call, my favorite, my least favorite. It's very common. It's what most traders start with. It's what most traders, hey, I can trade options. I'm going to learn this thing about trading options. Long calls, not my favorite. But are they effective? Of course. Are they cheaper than buying stock? Yes. Right. So long calls, I'll just list them first, and then we'll dive in a little bit deeper. So we're going to go bullish strategies, trade the market bullish, long calls. I really like bull call spreads. I really like bull put spreads. And there's all sorts of other fancy ones. If you want to be bullish, you could do, um, put ratio spread. You could do even selling puts. Selling puts is still considered bullish. There's all sorts of fancy stuff. You could do, let's see, a reverse. I'm not going to get crazy complicated. I'll start with these. Okay. Let's start with this. Because if you've been following me for the last, let's say, 6 to 12 months, I probably talked a lot about these on and off of different services and strategies. So you'll see me take a lot of these trades in my positions. Also, you can do. I mean, there's fancier ways here. I kind of like the broke wing butterflies. It doesn't matter. I'm not going to get crazy complex here. This is about kind of what everyone can get their head around within about an hour session today. So we'll talk this. Okay. We'll go bearish strategies. Bear strategies, we can do long puts, we can do bear put spreads, and we can do bear call spreads. We can also do a call ratio spread. Okay, so I'll just kind of flip these in reverse. All right, so let's make this our list and let's go through each one. All right, so long calls, long puts. Long calls, you are buying the call at a set strike, which is your asset price, and a set expiration, which is going to be your contract expiration. And so all option trading is you are agreeing to communicate to the broker that I want to buy this underlying asset that represents shares of this stock for a certain strike price at a certain value, which is what I'm paying for it, and by a certain time period. Okay? So as an example, well, and I'll just use like simple examples here for today. So let's just use like SPY as an example or Apple for an example. So let's say the SPY is right now, SPY is trading at what? 578. Okay. SPY is trading at $578. We can agree on that? Okay. So SPY is trading at 578. All right. We believe, and this is just all hypothetical here. Okay. We believe that the SPY will increase in value or rally bullish in the coming days. Let's say we're going to give ourselves, this is a nice thing about options. I don't have to be right today. I can be right in a week. I can be right in a month. I can be right in 3, 4, 5, 6 months. But let's just say, I'm good for maybe the next 60 days. I'm pretty confident that if the market goes up, I can find a way to generate money doing that. Okay. So a long call option, what can we do? Well, we can buy an at the money long call. Okay, so right now, if we went out, let's say 60 days, so we go 60 days to expiration, and we can buy the 578 long call. All right, so let's see what that's actually trading for right now. If I go SPY and I go out roughly 60 days, right now I can go out 56 days to April 30th, and I can buy an at the money call. Okay, so we're trading at 579. I'll buy the 579. It's going to cost me, we'll use just round numbers here, $17.70. Okay. So this is actually a 579 call. I'm just doing this with a live example. 579 long call for $17.70. Okay. So when I explain these strategies, it's really important that you can understand the if then. If I do this, then what does it mean? Where does price have to be for my break even? Where does price have to be for me to make money? Where does price have to be for me to have any risk? Does that make sense? So that's really, if I can, streamline and simplify options trading, especially when traders like have no clue or they're just trying to learn and it's very confusing with all these silly names. Just think about it with if then. If I do this, then what does it mean? Okay. So if I buy an at the money long call, I'm going out 60 days, right? And 56 days is the real example, but let's just say we're going out 60-day window. I buy the 579 long call for $17.70. Well, what does that mean? Okay. Here's what it means. So the breakdown is this. I am telling the broker that I'm willing to buy the SPY at 579 for a $17.70 premium. So I pay this debit. Okay. That's what I'm telling the broker. Is there any assignment risk in this? No. This option could trade. You can make money. You can lose money. It could expire worthless. It could expire in the money, but there's no auto execution here. If I buy a call at 579 and price is trading at $600, we're going to do some math on this. Okay, so I'm telling the broker that I'm willing to buy the shares of the SPY, like one contract represents 100 shares of the SPY, and I'm willing to buy the SPY at 579. And the broker's saying, okay, that's great. We like your trade. We will accept we'll accept your offer for a $17.70 premium. Okay, and that's what this transaction is going to look like. So what does that mean? Well, that means that $17.70 debit equals $1,770 for one contract. Okay. So it also means that 579 plus the $17.70 is going to equal my break-even price. So the strike price plus the premium that I'm paying for it is now where price of the SPY has to be in order for me to see profits on this trade. Now, that's only true if it goes all the way to expiration, okay? But just so we know what we're dealing with here, 579 plus 17.70 means that my break even on the SPY is 596. 596.70 is my break even price. Okay? Everybody follow me? Type in a where yes, you're following me right now. So if I buy this 579 call and the broker says you got to pay 1770 for that, well, with one contract, that's a debit of $1,770 on one contract. That's also my max risk on the trade. Okay? So max risk is 1770. So $1,770. My max profit is unlimited. And this is what makes call options so attractive. Well, if I just buy a call option and the thing goes up a ton, I can make a ton of money. It's true. But where does price actually have to go to make you money? Right? But remember our break-even price. So here's the trick to trading a long call. Okay. If you think about this just from, if I do this, then what needs to happen? If I buy the SPY call for $17.70, I need this SPY to go up greater than 596.70. Because if I let this go all the way to expiration, if price is above 596.70, then I can make money on this contract and I can trade this all the way to expiration. So if I go out 56 days or 60 days and it's above 596, then that means I'm making real money on the trade. Okay? So this is where the option stuff gets a little bit more tricky and a little bit more nuanced. So there is real value in the option and there is time value in the option. And this is the fancy word of intrinsic and extrinsic value. Okay? All that means is if I trade this from start to finish, from the beginning of my trade all the way to expiration, if price is not greater than 596.70, I do not make any money on this trade. And this is where a lot of traders get burned on a simple call option, is time is not your friend when you're buying an option. Time works against you. And so if I go out 60 days, this trade is probably the most profitable for me within about a 30-day window. And the reason why that's the case is because time does this. This is a typical decay curve in an option contract. And so we have roughly 1/3 to the second third to the final third, and this is time working against you. And so you can see that you don't really want to be holding this trade until expiration unless you're still extremely confident that you can get into a break-even price or better. And so for this option to make money before it goes all the way to 596.70, you want that trade to move directionally in this window right here. If let's say this is over 60 days, so within about the first 20 days or the next 20 days, so this would be about our 20 to 40 day window, and this is going to be our 40 to 60 day window. So time is still fine. Time is your friend in the first probably third of the trade. Time is starting to move against you a little bit, starting to be a little bit more of an enemy the second third of the trade, and then the final third of the trade, time hates you. Time hates you, it moves against you, and you need the underlying asset to be greater than your break even, or else you're going to lose money on this trade. Okay, so this is where you want to be right. This is why timing can be everything when you're trading call options. This is why timing is everything if you're trading put options. If you're long the option, you need time to work with you, right? You need time to basically have little to no effect. Okay, so if you think about this, if I'm going out 60 days, realistically, I want this trade directionally to work within about 20 to 30 days. Because if it's after that, I'm getting into this window here, and time is not my friend. Does that make sense? Okay. So this is why, like, we do the math here. What has to happen? 579 plus a break even that makes our break even price 596.70. So here's how we make money on this trade. Okay. How do we make money on this trade? If SPY moves to, let's say, 590 within 10 days. Okay, our 579 call option will have profit. Okay, I don't know what the exact profit's going to be, but roughly, we are probably going to see we're going to see some real value to the trade. We're going to see some real value and time value still holding. So we have real value directional movement, plus we still have time remaining in the trade, which gives us intrinsic plus extrinsic value, which gives us profit. And why is that happening? Because we took the trade, and directionally early in the trade, before time really starts to work against us, we're seeing that we're making money because direction is right and time is still not hurting us. Okay? So the simple way to think about this is, let's say we get this thing nailed. Let's say we have this like beautiful trade, this perfect trade, and the SPY goes all the way up to like 600 and let's say $605 as an example. Okay? Move this over here. I realize here with the length that I'm going to some of these strategies, we might just have to do more of these sessions, which I'm totally fine with. But maybe we spend a lot of times just getting through some of the course today. I still got plenty of time. I'm going to go until probably 2:30 or so today. All right. So let's say, again, just an example here. Let's say the SPY rallies to 605 in 30 days. So our rough calculation is this: 579 to 605 is what? $26 in value. Correct me if I'm wrong. Okay. Yeah, John, it's going to be recorded. It's archived. It's always on my YouTube session, youtube.com/Chris Pulver, youtube.com/Financial Wars. These are always going to be archived and posted in the live section. Yep. But I appreciate being here, and go check out the recording. Okay. 579 to 605 is a $26 value, right? Perfect. Okay. A $26 value. Now, we might still get some extra time premium. Maybe we don't. Doesn't really matter. I'm just going to calculate it based on what I know is real. Real value is the underlying asset went up in price. The underlying value is now up greater than my break even, allow me to have some real value in the trade. So a 579 call and the underline's now trading at 605. That's a $26 value in my trade. Okay. So if $26 in value is going to be roughly a $26 credit on this trade, what's my profit? What's my profit potential here? If I were to say I'm happy with this, 605 is a good level. I think the market's been a little bit overstretched. I'm 30 days into trade. I'm going to protect some profit. What's my profit potential? Well, a $17.70 debit to now a $26 credit is going to be a what? $8.30, right? 26 minus 17.70, $8.30. Okay. Again, why are you asking for following? I paid $17.70. It's now showing $26 in value. $17.70 minus 26 is $8.30 of profit. Okay. So if I was happy with that, what's $8.30 out of the original debit that I paid? $8.33, which is now my profit potential out of the debit that I originally paid, $17.70. I'm showing a 46.8% return on risk. Because my risk was the full 1770. That's the most I can lose. I'm seeing 46.8% return on that capital, on that risk. Am I happy taking profit there? Sure. What do I need to be a break-even trader? Well, obviously, I have a pretty decent win rate. If I'm going to risk double, right? I'm getting less than 50% here, so I'd have to make. The hard part is if I try to be greedy and I'm going to hold out and see like, okay, I'm going to hold out until I get 100% return. We might not get there. We might not get there because the asset doesn't move fast enough and soon enough to get you that big honk and win, right? This is the problem with paying for long calls. This is the problem with paying for long puts. You need the asset to move directionally and you need it to move fast. And oftentimes this isn't the case. But a 46.8% return on risk is still really darn good. Okay, so $8.30 profit. And that's a 40, is that 48.6? 8.30 out of 17.70. 46.8. Okay, and that's the trade. Come on. There it is. All right. Is everybody following this right here? So if I like the trade, if I take the trade, what does the trade look like? What is my strike? What is my expiration? Where is my break-even price? If the asset does what I need it to do, which is go up in value, up in price, is it doing this in a time window that I can still make money? And the answer is yes, 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 yes. Right? The price goes our way. The price goes our way in the right time. The price gets us above our break-even price and gives us some real value on top of that. Perfect. This is a good environment, right? It's a great trade. Okay. So, in a nutshell, you can think about any long call this way. If you trade a long call on Tesla, long call on Apple, long call on Microsoft, long call on QQQ, long call on Palantir, I don't care. It all works the same way. What is your asset? What is the strike price? How much do you need price to move? How much time are you giving price to move? And the best practice takeaway here would be whatever time you give yourself on the expiration, you have about half that time to really make the most money. Because after that half cycle, after we get to that that 2/3 of the trade is done, that final third, that time decay is so aggressive that it never really works to your advantage unless you're just getting real value in the trade, which means you're already covering the break even, you're already getting prices to keep going your way, and that's okay. But the real juice in these trades is whatever time duration you have, if you're getting the price to move within about that halfway point. That's before the time really affects you. That to me would be my best practice. So if that helps you think about, I like to trade call options. So what do I do differently? Right? So John's asked a question, how do you factor in time decay? That's what I'm saying. It's about halfway. So if I'm going out 60 days, that's what I'm saying. From a 0 to 60-day trade, just as an example, this is 60 days out. About 20 days is not a lot of decay. 21 to 40 days is a little bit more. And then 40 to 60 is the worst. So what you're trying to do with time is if you're choosing a 60-day expiration, You want that trade to be working for you directionally within about this window. Okay. And maybe about the halfway point. I'd say between a third and a half of the way there, that's where you get the best bang for your buck. If you're right directionally, that's where you get real value and time value still working for you, right? It doesn't hurt you with time. But anything beyond that, anything past that, like 2/3 mark, it starts to get more aggressive and time is not your friend. So you just have to consider that. And look, it's expensive to go out 60 days. It's expensive to go out 90 days. It's expensive to go out 120 to 600 to 360 days, right? You pay a lot of money for that. So that is why I like other styles of trades, because a bull call spread or a bull put spread, time doesn't affect us nearly as badly. Okay. Time, in fact, doesn't really hurt us at all. We just need the price to be above a certain level and we make money on these trades. Okay. Paul says you can pull out at any time. You can, right? So let's say that, let's say right here, if this is, we'll say 20 days of the trade. Okay. And then by 30 days of the trade, we're right here. And then by, day, let's say 45, we're right here. And by 60, we're down here. This is just time, by the way. This isn't like, oh, that's the value of my option. It's just time, right? So time is not going to be our friend. Time is not our friend when we're long options. But if the asset price goes up, time is not hurting you as badly because you're still getting what you need out of it. I needed to cover the cost of my debit. I want to see if I have real value in the trade. And if I'm getting the asset to go my direction and it covers the break even price, then I've got profit to manage. And then you can make the decision of, well, I've got real value in the trade. I'm going to let this go towards expiration. I'll take as much out as I can, right? The question with options and the best success I have with trading long calls is I'm usually looking to manage the trade around the halfway point. If I'm going out 60 days, the best thing for me to do is to just say whether I make money or lose money, it's probably best that I cut the trade off by like 30 to 35 days, whether I win or lose, because time doesn't hurt me as badly. And you're not always going to have winners, but your losers will be not 100%. Like here's what sucks about buying calls. If, okay, let's say that we go from 579. I'm just drawing this out here. This is a crappy example. Say this is why long calls can be frustrating. So we buy the 579 long call. Let's say the SPY rallies to 590. And you're all excited. Oh my gosh, I just got $11 of movement. Let's go. I'm close to getting a break even or better. My price is 596. But let's say at 590, the market starts to go sideways. Let's say at 590, it goes 590, 588, 590, 585, 590, 585. It goes sideways. Time, every single day that time passes, it's not helping you because time is going to start hurting you. And are you break even or better at 590? No. So the asset has not moved enough and time is now working against you. And now you're on the clock. Because if you let it expire all the way 60 days out and you're like, well, I think it can still rally. I hope it still rallies. You're still going to lose on this trade. Because if you let it go all the way to expiration and you have a 590 price, you've only covered $11 of value in your trade, right? I paid $17.70. The asset only moved up $11. That means I only have $11 of value in my trade and I paid $17.70, which means I lose. So even though I was right directionally, even though I gave the trade plenty of time to work, it didn't move far enough and fast enough for me to make money. And this is the vicious cycle that a lot of long call option traders get themselves into is they get burned on time. Time hurts. The assets don't move enough. They don't move fast enough. This is why it's frustrating. Okay? That's my point. So, are we good on long calls? Makes just again, just a one conversation, SPY example, but you can take this and put it into Apple, Microsoft, Tesla, Google, Nvidia, whatever you want. It works the same way. You choose your asset, your strike prices, how long out you want to go for that particular trade, and does price move enough and fast enough to cover the cost of that option or the debit that you paid and then get you money in the trade. The best way to manage these trades would be about the halfway point. If you have real value in the trade, plus you have time value, take your profit and move on. That's probably the best way to be successful with these trades. All right. If you hold these to expiration, the crazy statistic is about 70 to 75% of all options if held to expiration, will expire worthless. Think about that. 70 to 75% of all options that trade held to expiration will expire worthless, which means they expire out of the money. This is why holding long calls to expiration isn't going to work very well. This is why holding long put trades to expiration isn't going to work very well. Okay? All right, just want to make sure that's clear. Now, I'm ready to move on to another example because I think that's a good example. We can translate that. You want to watch the breakdown again. It's really just simple math, right? I bought at 579. I paid 1770. I know that I've got to add that strike price and premium together to get my break even. And now I'm on the clock. I've got 60 days to make this trade work. About 30 days into that trade, I should assess whether or not I'm going to be willing to hold it or keep it. Hopefully, within a 30-day window, it works. Okay. Interesting news on the day. Equities rise intraday as Trump grants tariff exemption to automakers. Just breaking news right now. Markets are up on the day. We're coming back up towards the highs. This is why I did bull put spreads for the afternoon, which, by the way, that 50 cents should be showing for a nice little winner here. SPX for today, 50 cents, and it is now trading for 1, 2, 3, 4. Trading for 10 cents. I'm just going to let it expire worthless and keep the full 50 cents today. I'll take that additional winner. Okay, let's move on. Long calls, we're good. Okay, I'm going to delete all this. You can watch this recording at any time. There we go. Let's go to the next one. Okay, bull call spreads. Now, here's what's nice about this lesson. If I layer in this education, I'll use the exact same asset, the exact same scenario, and we'll still talk about the risk profile. And now we're going to do it from a debit spread. So a bull call spread, again, stupid name. All it is a debit spread. Here's what it means. Okay. I believe the SPY will go up in price over the next 60 days. Just an example. Okay. I'll use the same examples for simplicity. We talked about the SPY at 579. I'm going to talk about the SPY right now at 579. Okay. All right. So SPY is trading at 579. Okay. I would like to trade a debit spread. So if price is greater than 579 or whatever my price is, we'll do something very simple here, 580, before I'll put near or at expiration, I will keep a majority or all of the profit potential. Okay, so here's an example. SPY's trading at 579. I believe the market's going to go up in the next 60 days. So what do? Well, I can trade the long call option, which we ran through that. We know our break-even price is 596 and change, 596.70. Here's what I can do on a bull call spread. I can buy a 579 call and I can sell a 580 call. Okay? So what does that look like? Well, that is a $1 wide spread. That's all it is. That's all it is. It's a $1 wide spread. Okay? I have to pay, let's say 60 cents debit for this trade, which means I can keep 40 cents max profit because we take our $1 wide spread minus the 60 cents debit equals a 40-cent max profit. Okay? Fair, right? It's not awesome return on capital, but it's good. We did an example where the SPY was up to 605. We did the math and we made a 46.8% return. Just throwing it out there. Okay? And that was a good trade. The underlying asset went from 579 to 605, which covered our break even, gave us some real value in the trade, and we closed out for a nice winner, about 48% return on risk. That's still good. Now let's break the numbers down here. So I buy the 579 call, and against that, I'm going to sell a 580 call. Okay. So if the broker says, okay, you can do that, let's look at the price right now. So if I go SPY, I'll go out 60 days. So there's my 56-day expiration, just as an example. I'll do an at the money so I can say this is pretty realistic. Right now, the broker says it's about 62 cents. If I go up a strike, same price, about 62 cents. 60 is fair. right? 60 cents. So here's what I need. Okay, now where's my break even? This is what people get, like, this is what's so ridiculous about people telling me like spreads are too complicated. You're crazy, because now look at the difference in what I need price to do. Okay, I need price to be greater than $580 anytime over the next 60 days. Okay, now for the full profit, it's greater than 580 by expiration. In order for us to get the full dollar credit and walk away with 40 cents profit, we need it to be above 580 by expiration. That's all we have to have happen. That's it, right? So what's the break even on the long call? 596 and 70 cents. What's the break even on a bull call spread? 579.60. Isn't that ridiculous? Like, look at how much less we need and require the asset to move. We need SPY to move and stay greater than 579.60 to be break even or better. So if you were going to put a probability on this, what is the probability that the SPY can stay above 579.60 versus the probability of it staying above 596.70? Isn't that a ridiculous difference? So, and I want to treat the risk the same, right? So let's say we take this trade and we're paying 60 cents. Well, if the previous trade I was going to pay $1,700, what's 1770 divided by 60 cents? Okay, I can get in this trade for, I mean, that's a ridiculous amount of contracts here, but I can get in this trade for like 30 contracts. 60 cents times 3,000. Yeah, I could take 30 contracts on this trade and risk the exact same amount that I was risking on the long call. And what do I need to get? As long as price stays above 579.60, I make money. It's break even or better. If we stay above 580, I can keep the full profit. Okay. So this is what I'm saying. Like, let's layer this in where like the example is the same, so it's easy to follow. The risk is the same, so it's easy to follow. So let's do that. So this would be on one of the most liquid instruments in the world. The long call for one contract was $17.70. We could do a 30 contract SPY 579 buy call by 580 sell call for 60 cents debit. Okay, so that would be max risk of $1,800, close enough to the 1770, and our max profit, it's not unlimited. Our max profit would be 40 cents, okay, times 3,000. Our max profit would be $1,200. Is everybody following me on that trade so far, as far as this math goes? So we're going to take the same risk. If you're willing to buy a call option or you're willing to do a spread, same risk, you're going to trade more contracts. So a 30 contract SPY is the same risk, but all I need to do is see price stay above 579.60 or get above 580. That gives me max profit. So my max risk, the most I can lose on this trade is if price goes down below 579, price can fall to $550, price can fall to $500. The most I can lose is $1,800. It's risk defined. The most I can make and gain is, yes, my dollar spread. So if I'm paying 60 cents to make $1, I pay 60 cents, I make $1, I net 40 cents, I still make $1,200. What's my return on risk? 66.6%. Which is better? 48.6% on a long call option or 66%, almost 67% return on capital, return on risk with a debit spread? I'm just doing math here, but I think that making 67% return on risk is better than 48.6%, and the underlying asset had to move $1, not $17, not $18, not $25. It had to move $1, right? And how does time affect this trade? Time really doesn't hurt it nearly as bad. The only thing that matters here is when we take a trade like this, time still has its typical decay, right? It still has its, first, third, second, third. But in this factor, If price goes up aggressively, we're just not going to see the full dollar, right? Let's say price moves really aggressively. Well, a 60-cent debit is probably going to trade for 73 cents credit, 75 cents credit, maybe 78 cents credit, maybe 80 cents credit. So if we wanted to take profit, we can take profit at any time. If our credit that we can see is higher than the debit we paid, we can still make money on the trade. So if price goes up aggressively, there's two ways to look at it. Either one is, hey, price is going my way, awesome, right? Price is going my way, that's fantastic. Do I want to take the profit now or do I want to let it go? Because the probability now of price coming all the way back down below 580 or coming back to my break-even point is a little bit thinner. And that's why time doesn't hurt us nearly as badly, because once price is up here, the probability of coming all the way back down to our break-even is lower. So the probability of us keeping our profit or keeping a majority of the profit or keeping even max profit is increasing. That makes sense? Okay. So if we just look at the math here, does this make sense? I'm taking the same asset, similar trade setup. I've got the same theory. I think that the SPY is going to go up, and I'm trying to express that in the market. If I just buy a long call, I pay $1,770. One contract. If I do 30 contracts on a debit spread, I'm going to risk the same amount of money, max risk, but the return on risk is greater, and I only need the asset to move $1. That to me is why spreads are fantastic. My return on capital is still very, very good and favorable. My percentage of winning is good and favorable, and the asset itself only has to move a tiny little amount, and we can make that profit, right? That's the nice thing about this trade. I think that's pretty good. So that's why I would do it. This is why I would take a debit spread typically over a long call option, because the underlying asset has to move very, very little for us to make money. I think that's a fair trade-off. So what am I what is the trade-off? Well, if I do a long call option, there's no profit cap. I understand that. And that is the appeal to trading long options, is there's unlimited profit. Right. But you can see the trade-off there. You pay a lot for it and you need price to move aggressively in the window that you're trading, and you need it to move about half the time. Right? If you go out 60 days, within about 20 to 30 days, you want that price to be ripping to the upside to get your call options to make it look like you're a genius. Otherwise, you're fighting against time, price isn't moving, and you're just watching time hurt you, and your trade's not going to get to break even or better, and you lose on your option trade. And you still got direction right, but it didn't go up far enough and fast enough. But a bull call spread, super easy. Buy a call, sell a call, risk and return. I need the price to move $1. Big friggin' deal, man. This thing moves like $5 a week. This move moves $10 a week. Okay, so that's why I like spreads. Now let's take this another way. So we've got long calls, check. Bull call spreads, check. Bull put spreads. Well, that's just a credit spread. Here's a different way of looking at the market. Okay, bull put spread. Bull put spread is a credit spread. I'm going to literally type this out. It's going to be very similar. We're just going to take a slightly different trade. I believe the SPY will go up in price over the next 60 days. Okay, SPY is trading at 579. 579. I would like to trade a credit spread. So if price is greater than, let's say 579, near or at expiration, I will keep a majority or all of the profit potential. Okay? So debit spread is I buy a call at a lower strike and I sell a call at a higher strike. It creates that spread. The width of the spread minus what I pay for it is my max profit potential. What's my max risk? What I paid for the trade. A credit spread is a little bit different. Okay? So I can sell the 579 put. Okay? And I can buy the 578 put. Okay? So let's say that we do that. That is a $1 spread. I am able to collect, let's say 40 cents credit on this trade. which means $1 wide minus 40 cents credit equals a 60-cent max risk per contract. So the numbers are going to be very similar, right? So my max risk here would be 60 cents. My max profit and credit would be 40 cents. I'll do the same thing I did, right? So we can do the long call for one contract was $17.70. A bull call spread for 30 contracts was $1,800 max risk for $1,200 max profit. A bull put spread, which is the credit spread for 30 contracts, it's going to be the same. If I take the 40 cents credit times 3,000 because I'm doing 30 contracts, it's still $1,200. $1,200 max profit because that's my credit received for the $1,800 max risk. So it's expressing the same thing. One is just I pull the credit up front as a credit spread trade. I get the credit up front. And then it's just a matter of do I get to keep that credit as time goes to expiration. And remember that 70+% of all options, if held to expiration, are going to close and expire worthless. In a credit spread, I want the trade to expire worthless, always, because that allows me to have full credit. Okay? What's the difference between a debit spread and credit spread? Well, a debit spread, you take away the assignment risk potential on something you could own. Can you own the SPY? Yes, it's an ETF, so you can own shares of the SPY. Could I do this on a SPX? Yes. Could you own shares of SPX? No, it's not something you could get assigned. It's a cash settled index. Okay. So this can be translated to something like SPX, NDX, XSP. I'm trying to think what other like you could trade futures contracts this way. Like if it's risk defined and it's a debit spread, there's no assignment risk. Credit spread, there could be, even though it's a low probability, there could be an assignment risk because something that could be assigned could be assigned. So if the SPY dropped down to, let's say, $550, the broker might attach me as a seller, right? I'm willing to own the SPY with a sell put at 579, right? I'm selling a put at 579. What that tells the broker is I, as the trader, am willing to own and also obligated to own the SPY at 579 if price is down below it. Okay. Now, yes, I'm still putting a spread on, so I shouldn't have to own it because I have a long put that helps me get out of trouble. But the market's made up of buying sellers, and there might be a 3 to 5% chance that if price drops really aggressively, I might be left as a seller saying I'm willing to own the shares, and the broker would assign me, right? But there's an easy way out of that because we still have a long put. That's a hedge. We can still close out for the exact same risk we took on the trade. I teach traders this all the time. And it's not difficult, but the panic comes in when I just got assigned 100 shares in the SPY. The broker says I need to pay him $50,000, and people just lose their freaking minds. The reality is you still have a long put because you won't get assigned the long put. So if you get assigned a sell put and then you still have a long put, just close the shares and close the long put and close it out at the long put price, and you close out the trade for the exact same risk. I'll go another example if we need to. All I'm saying is the probability of assignment is very low. But when people emotionally make terrible decisions, I have to talk about that as a contingency plan because it will happen every now and then. Okay. All right. So anyway, bull call spread for 30 contracts, $1,800 max risk, $1,200 max profit. If price were to go above, what do we need the bull call spread to do? Bull call spread needed to be above 580 at expiration, or a break-even price was 579.60 because that was our debit. On this example, okay, where do I need price to go? If I sell the 579 put for a 40 cent, I'll put so I'll put this both. So and buy the 578 put for 40 cents credit, the math works like this. 579 sell put minus the 40 cents credit is going to equal a 578.60 break even. So that means this. As long as the SPY is greater than 578.60 by expiration, I am break even or better. As long as the SPY is greater than 579, okay, 579, 579.01 by expiration, I keep the full 40 cents credit on the original trade. Okay. So remember how I was kind of harping on where's the break even? Where does this thing need to go? Well, if a long call has to go to 596.70, a bull call spread needs to go to 579.7 or 60. A credit spread only needs to stay above the sell put level. So if we did a 579 sell put and a 578 buy put, the SPY literally just has to stay above 579.01 over these 60 days. If it does that, I can keep the full 40 cents that I collected. So how's that trade work out? Well, if I take the trade originally for 40 cents and time passes, this is where time doesn't hurt me at all. The more that time passes, the more this 40 cents becomes 30 cents, 20 cents, 15 cents, 10 cents, 9 cents, 8 cents, 5 cents, 4 cents, 3 cents, 2 cents, 1 cent until it's zero. So I take the trade for 40 cents, time decay closes at zero, right? The option is out of the money. The option is now considered worthless, but it's perfect for me as a credit spread trader because that 40 cents that I took in on the trade is now trading for a 0 cent debit, right? This is a DB for debit. So 40 cents credit, time gets it down to a 0 cent debit, and I collect and keep the full credit. Okay. If we don't want assignment risk, we should always do, yes, I don't like definitives in the market. When you're saying always, always, I never like that. There's a time and a place to trade debit spreads and credit spreads. But if you're asking for never, ever, ever having assignment risk, then yes, debit spreads, there's no assignment risk. Okay. Credit spreads, there is, but it is a 3 to 5% probability of getting assigned. It's very rare. The only so look, I'm a U.S. trader. There's a difference between American options and European options. Okay, European options, they only settle at expiration, never before. American options can be exercised and assigned at any time during the contract. So if I go out 60 days, if something crazy happens and I'm a buyer and seller that has to get matched in the market, there might be an assignment somewhere in between. I've had shares that have been assigned, like, I take out 45-day expirations. I got assigned 20 days into it because the market was down a bunch and, I'm sitting here with a sell put. Well, fine. I still close out the trade for the same risk. Or I keep the shares and I, repair it. So anyway, does this make sense? Does this make sense? So long calls, does that make sense? Bull call spread, does that make sense? Bull put spread, does that make sense? Okay, a put ratio spread. I'm going to save this for another strategy session because a put ratio spread it's a good way to take on credit, but I only do put ratio spreads if I'm willing to own the underlying shares. That's it. I'm always willing to own the shares if I do a put ratio spread. And if I've got traders watching this that are like, I can't afford to own, Netflix at $900. I can't afford to own the SPY at $580. Then we're probably never going to do a put ratio spread, right? Same thing with a call ratio spread. Plus, I'd never ever take on shares with a call ratio spread because I'm not going to own shares short ever. I don't sell on margin. The only way that I hedge the market, the only way I trade the market down and bearish is going to be through these three things. Okay. Do I like call ratio spreads? Do I like, little sophisticated strategies to make money on tops? Of course, but it's for income generating trades only. I'm not looking to sell the market. I can express my bearishness with long puts and bear put spreads and bear call spreads. Okay. All right. So I hope this makes sense. Let's go another, the nice thing is if I build a really solid foundation for this first part of education, like long calls, and you can see how easy it is to just make it one wrinkle different. A long call is very different than a bull call spread. A bull call spread is different than a bull put spread, right? One's long call just by itself, it's one leg. A bull call spread is a debit spread, it's two legs. A bull put spread is a credit spread, it's two legs. But it's not that complicated when you think of it with the if then. If I do this, what has to happen for me to make money or lose money? Okay. And so I hope this helps drive home the fact. And look, I'm going to see if I can get Prosperity Pub to share this with as many people as possible, because I cannot believe how many times I hear this. When traders hear the word spreads, they don't want to trade it. They want a different strategy. And I'm just like, what's the other strategy you want to trade? Because if you're trying to tell me that your preferred method of trading is only buying calls and only buying puts, then you are climbing a hill that is almost insurmountable, because time and premium is always going to work against you. You're always going to pay too much for those option trades. You're going to have time working against you the entire time. And I cannot believe that traders think like that's the best way to trade. So I'm here to open up open the curtains and show, like, it's not that different. Just to think of, if you like long calls, you should love trading spreads. Seriously. And you should like them because they're easier. And it's way better for me to only need the underlying asset to move a tiny little amount. That's what makes them better, in my opinion. I need like a $1 move or a 10-cent move or a 1-cent move, and I can still make money on my trade. You know, that to me it's like, that is a no-brainer. And that's where traders get in trouble, is they need the underlying asset to move, and sometimes it doesn't. And that sucks, you know? So anyway, I hope that makes sense, because in the next 8 to 10 minutes, I could probably go through long puts and bear put spreads and bear call spreads, and we can do the same example, and we're just going to flip it and say, well, now we want to trade the market bearish. That makes sense? So let's see if we can knock it out in the next like 12 minutes. I'm going to go until about 2:45, and then I've got another session at 3 o'clock that I'll do. That'll be my final hour session, which will be a nice way to close up the day. Okay. The issue with the spread is the price moves very fast. Our target, we'll have a long way to go to expiration. It's true, but it also trades for most of the profit. So, I mean, example being, if I did a credit spread and I pulled in 40 cents and the price rips in a week or two, right? I go out 60 days and the price goes up in 10 or 15 days all the way to 600. That 40 cents is not trading for zero yet, but it's probably trading at like 8 cents, 7 cents, 6 cents, 5 cents. So then you have to ask the question, is it worth waiting all the way to expiration to get my extra 5 cents out of this trade? Or should I just take the profit, move on? I'm the ladder camp trader. If I've got 35 cents out of my 40 cents max profit, I'm going to take the profit, move on, and reallocate how I want. The bull call spread works very similar. If price goes from 579 to 600, our 60-cent debit is probably going to trade for 70, 75, 80 cents credit, 82, 85 cents credit. If it gets up to 90 plus cents credit and we still have, 15, 20, 30 days left in the trade, is it worth holding out for the extra 5 or 10 cents of extra profit to max it out? Or is it just worth taking the, 90-cent credit and that's it? Take your 30 cents out of 40 cents max, walk away, you make a bunch of money. Take the profit. So I get it. Like, yeah, time, if the asset moves aggressively, it's like you still got to wait, right? But you get most of the profit very quickly, because now the probabilities have all shifted, where if we have a big move in our favor, the probability of that option that you took still finishing out of the money is insanely high. Then the option prices reflect that, and you're going to get probably 80 to 90% of the profit, if not more. So it might not be holding out to max expiration. It might not be holding to max profit, but if you can get 90 plus percent of your max profit, I'm totally happy moving on. Okay. Hope that makes sense. Okay. I'm going to delete this portion. I'm going to delete this portion, and we're going to do a long put, bear call. We're going to do those three, and I'll wrap up the session. By the way, as we're doing this session, how we doing? How's the feedback? Are you learning? Is this making sense? Is this opening up your eyes a little bit to trading spreads? I hope that it is. Okay. This is really why I want to do the strategy. I like I said, I can't believe how many traders I hear, like, they hear spreads and they get intimidated, they get overwhelmed, they don't want to do it, it's too complicated. No, it is not. This is the easiest stuff in the world. All you have to do is understand just the basic mechanics of, if I do this, what does it mean? You can answer those couple of questions. It's just a trade. The difference between one leg and two leg is not that big of a deal, especially when it comes to, I only now require the underlying asset to move just a tiny bit in my favor, and I can make some money. All right, good. All right, so let's do long puts, and bear calls right now. So a long put. Long put. The nice thing is I can go through each of these examples pretty quickly. We're going to use the same underlying asset, same prices, and just do the math. So we'll do long put. Okay, I believe the SPY will go down in price over the next 60 days. Okay? SPY is trading at 579. Same example, same underlying, same price, just to make the examples much, much easier to stomach. Okay? All right. So the SPY is trading at 579, and I believe it's going to go down. So what can I do? I can buy a 579 put for 60 days to expiration for, let's find out the price. Give or take, it's not going to be spot on, but let's just say I buy an at the money put over the next 56 days. It's going to be we'll say $14.60. Okay? $14.60 debit. So what does this mean? This means that 579 is my strike price and my debit or premium paid is $14.60. On one contract, that's $1,460 per contract. Okay? My break-even price is 579 minus 14.60. My break-even price is 564.40. Okay? So if the SPY is less than 564.40 by expiration, I make money on the trade. Okay? And the flip side of that is if it's not below 564.40, I will watch 14.40 debit trade for $0 credit. That sucks because the SPY could go to 569, 568, 567, 566. But if it doesn't do it fast enough and it doesn't cover my break even, that $14.60 can literally be zero, and you could see the price $10 lower, right? Man, I got direction right, right? I got direction right, but what ends up happening? I didn't cover the cost of my trade. Now, we don't have to take a full loss on it, right? If it was down $10, we still get $10 of real value in the trade. But basically, if we don't cover our break even, we're not going to make any money on the trade. Make sense? Okay. So time is working against us, as I said. So in this example, 60 days to expiration, we want the SPY to fall fast and hard and in a short amount of time in order for our trade with real value plus time value to make us money. So as an example, and I don't want to say this like, we should never trade puts. No, it works. But let's say this. Let's say the SPY drops to 555, okay, in 40 days. We'll just throw it out there. So the SPY drops from 579 all the way to 555. Well, 579 down to 555 is a $24 move, right? And that's $24 of real value. If we still have any time premium left, fantastic, but otherwise, real value is what I get. So I'm just going to say we get real value, maybe a little buffer of like, oh, there's still 20 days left in the trade. Maybe it helps, maybe it doesn't. But real value is what I'm going to calculate. That's what I know is true. I can't calculate the exact time premium that we have left in 20 days of trading. But I can say that if we're down to 555, that's a $24 move in the underlying asset, which gives us real value. And we paid $14.40 debit. So what does that equal? Okay, $24 of value minus the $14.40 debit that we paid for. I'm sorry, $14.60 debit. $14.60 debit. Is $9.40 profit, right? We paid $14.60. The asset dropped. We have $24 of real value. $9.40 is profit of the max $14.60 that we paid for the trade. So $9.40 divided by the $14.60 we paid, we get a 64.3% return. Not bad. Not bad. Return on risk. Sign me up. That's a great trade. But what did price have to do? Price needed to drop fast to cover the cost of my trade and get me down to a break-even position or better in order for me to take profit on the trade. So this example, we had the underlying asset drop $24. We needed it to drop $14.60. We need it to. If we want real value in the trade, it needs to drop $14.60. Okay, can that happen? Of course it can happen. Can it also not happen? Of course it can not happen. That's a lot to ask of your underlying asset. Okay? So, do you make trade? You make the trade, you make money? Awesome. Everyone's happy. Now let's take the example here and talk about a bear put spread. This is a debit spread. Same example. Okay? I believe the SPY will go down. SPY is trading at 579. I can buy a 579 put and I can sell a 578 put for, let's see what that debit's going to be. Right now, if I buy that, sell that, it's going to be about 40 cents. It's crazy how these numbers work. 40-cent debit. Okay. This is a $1 wide spread. I pay 40 cents debit, which means 60 cents is my max profit, right? A dollar wide minus the 40-cent debit equals a 60-cent max profit per contract. Now let's take the same risk. If my risk is $14.60 divided by, what's my risk here? 40 cents. I can take 37 contracts. We'll go 36 contracts, whatever. 36. It's kind of a weird number, but we'll go 36 contracts. So we can make it the same. So we can go 36 contracts with this spread is the same risk as one contract of the long put. Okay? So if I do 36 contracts, 40 cents is my debit. 36 contracts represents 3,600 shares. There's my risk of about $1,440. Okay? So max risk, 1440, which means my max profit would be 60 cents. 60 cents, 2160. Max profit is 2160. Okay, if I make 2160 and my max risk is 1440, what's my return on risk? 150%. I make more money on that bear put spread than I do with a great trade as a long put. Yes, the long put has unlimited potential if the market tanks and drops a ton, but how about a trade that makes us 150% return on risk if it just stays below what price? If I buy the 579 put and I sell the 578 put, I pay 40 cents for it. My break-even price, I'll put this right here. My break-even price is 578.60. So in order for me just to make money on this trade, as long as the SPY is below 578 or lower, I can make 2160 in profit versus a 1440 risk and make 150% return on risk. That is pretty good, isn't it? It is good. That's better than 64.3%. And that was with a great trade, right? All we need price to do is stay below. Now, same thing that came up earlier. Well, what if we have to wait further in time? Well, if price dropped all the way down to 555 or 550, our 40-cent debit is probably going to be trading for 75 cents, 80 cents credit, 85 cents credit, 90 cents credit. We can take a majority of the profit. We can still make a lot more that way and outpace our risk. I like the trade better. Okay? And I'll put this here. All we need is SPY to be less than 578 by expiration. That's it. So if you're willing to hold it that long, yeah, you want to see it stay below 578. If it goes really far down really quickly, then the 40 cents you paid for the debit could be trading for 60, 70, 80 cents credit. Take the profit, move on. You know, if you're collecting 80 to 90% of your max profit, oftentimes I'm just going to let the trade be done. I'm going to take the profit, move on. I'm better off not waiting for that tiny little sliver that's left in the trade versus just taking the profit, moving on. Okay? Make sense? All right, bear call spread. Bear call spread. This is a credit spread. I believe the SPY will go down. This is what's kind of nice. I mean, I've obviously done this for a long time. I've taught a lot of traders. I think these are pretty like digestible examples where it's the same asset, the same price, the same example, just a different nuance of trading it. I believe the SPY will go down. Okay, SPY is trading at 579. And I can do this. I can sell the 579 call, okay? And I can buy the 580 call. And I can probably collect 60 cents on that trade. Let's find out. If I were to sell and buy, let's do a bear call spread. So I do a sell call here and a buy call here. I'm getting 60 cents of credit on the trade. As I said, I've done this enough. I've got pretty real examples. This is what the broker is actually offering for that exact same trade. And I can get a 60-cent credit. So I collect the credit up front. Okay? And then time works in our favor. We want the trade to expire worthless. That's what a credit spread is. I take the trade, time passes, it expires worthless, I keep all my credit. Okay? So what does this mean? This is a $1 wide credit spread. I collect 60 cents credit, which is going to be my max profit, which means $1 spread minus 60 cents credit is a 40-cent debit or max risk. Right? If I take the trade, it's $1 wide, I collect 60 cents of that dollar, that means my risk is 40 cents. That's the most I can lose. Okay, I'll do the 36 contracts here. 36 contracts with this spread is the same risk as one contract of the long put. Okay, it's also the same risk as my debit spread. So max risk, if we collected 60 cents, 60 cents times 3,600, 2160. It's the same thing. Max risk is going to be the 1440. Max profit is going to be the 2160, and that's 36 contracts times 60 cents. And this one is 36 contracts times 40 cents. So what happens? Okay, all we need is SPY to be less than, this is what's crazy, 579.60 by expiration for break even or better. So if the SPY stays below 579, where we sold our call, we make money, right? So a bear call spread is like saying, I don't want price to go above that. A bear put spread is, I want price to go down, I'm just going to pay the debit spread. So again, with spreads, you establish a line in the sand. I take the trade, I need price to stay below this, and I make money. So if the credit spread is, I sell a call, I buy a call at a higher strike, I need price to stay below that, that's my line in the sand. Because I collected the 60 cents, my break-even price is 579.60. So in order to make full credit on the trade, to keep the 2160 max profit, all I need price to do is stay below 579. So if price goes all the way down to 555, 550, that 60 cents credit is probably trading for 10 cents debit, 9 cents debit, 8 cents debit, 5 cents debit. protect the majority of the profit, take your 85, 90% of the profit and move on. Okay. Return on capital, return on risk is still favorable with these setups. Okay. Does this make sense? Now, other takeaways here. I've got another session coming up 3:00. We're talking more markets and where things are at today. That's final hour. Other takeaways from this. We have an underlying asset we've talked about. We have some strike prices. We have some expirations. This is a 60-day example. It's just an example. This same methodology of time working for you, time working against you, 60 days, it can be the same in a 0-day environment, the same over a 30-day window, the same over a 90-day window, the same over 120 to 360 days. This is what the option market does. Okay? So what's crazy about current days is right now we can literally trade indexes and trade these, index ETFs with 0-day expirations. So all this right here that I'm doing happens in a day. It's crazy, right? It's the same thing. If you're trying to be directional in a given trading day, you better hope this day is very, very directional. So if I just buy a call, I better hope that day is really directional very quickly. Because I have one day, and it's not even a lot of time because I'm going from opening bell to closing bell. So that's not a lot of time. So I really have about 2 to 3 hours to make my money if I'm long calls or long puts, right? A spread, well, we have the day. Like today, I'm going to wrap up a trade here. I took a bull put combo. So my bull puts today, I did a 57.05 by 56.95. 10 wide. I collected, 30, 40 cents in the trade. The 5,700 by 56.90, same thing, 20, 30 cents in the trade. I've got a net 50 cents in the trade. It was trading anywhere between 50 and 75 cents credit. Now it's a lot more risk in a 0DT environment than it would be reward. But my probability is I was way out of the way. I was way out of the money. And the probability just says, look, in the next hour and 7 minutes, I'm probably going to have that trade expire for full credit and just keep it. Okay. All right. So before we wrap up and I jump into my session at 3 p.m., this session is being recorded. It's always recorded. It's going to be archived. It'll be on the YouTube channel. So you can come into my YouTube channel, youtube.com/Chris Pulver, youtube.com/Financial Wars. You can watch this as much as you want. I'm going to ask the team if they want to take this recording, send this link out. Great. I hope this helps. This has been a good hour and 20-minute session. If anybody's willing to take the time to go through this, I think you can learn a lot. So you can trade the market up or down. And the nice thing is when you do long calls, you need the market to go up. When you trade long puts, you need the market to go down. When you trade spreads, you only need it to go up or down a little bit. And that to me helps me a lot. That makes the probability of profit much higher. That allows me to still be technically taking my stabs and saying, look, I think the market's going to go up, so let me take a stab at it. That way I don't need the price to cover $15, $20 to get me break even. I needed to cover $1, 60 cents to get break even. That's insanely easier. So much easier. Okay. All right. So if this makes sense, how about a thumbs up? How about a like? How about a subscribe? I'm willing to do more of these strategy sessions as well. I think this is a nice little segment. I've got it built into my restream, so I can take this segment and we'll just do more of these. We can do some other strategies. I can do ratio spreads. I can sprinkle in some butterfly spreads. I can do all sorts of stuff. We can talk Forex. We can talk, trading futures. We can talk whatever we want. This is, my service to my followers out there. But there's no reason for me to ever hear that that's too complicated or complex or too hard. Because I think if you want to do this, look, Warren Buffett didn't become a billionaire. Ray Dalio didn't become a billionaire. Hedge fund managers that are well-renowned and known didn't become billionaires in the position they're in because they weren't willing to learn. They're willing to take risk. I mean, it's just trading. It's just trading. But I refuse to accept any objection where it's that's too complicated. What are you talking about? This makes trading easier. So I say embrace it and have some fun with it. Okay, hope that helps. All right, I'm going to take a small break. I'll be back at 3 o'clock, youtube.com/Chris Pulver, youtube.com/Financial Wars. I'm talking final hour, so we'll see where the markets are at. They're up. Markets are up. We're right back up towards the highs yesterday before the market imploded. I'm curious how the day is going to close. What I saw news-wise today was there was a delay in tariffs for automakers. That was the concern coming out of retaliatory tariffs with tariffs on steel or tariffs on whatever. I mean, automakers, also with Mexico, Canada, just the retaliation was going to, ruin Ford, automakers, whatever. But we'll see. So markets are up today. They're kind of happy. I still think there's more pain and uncertainty ahead. But this is going to help waterfall. We'll take a look at all that stuff today. I spent a lot of time yesterday after market just organizing for client accounts, and I was able to go through and comb the portfolio A to Z. So closed out some hedges today, which was great. And now I'm looking at some waterfall positions that are looking pretty good. Daily profit play was nice today. Ended up grabbing another winner. That is 1, 2, 3 winners on the day for daily profit play. Overall, pretty good. Overall, pretty good. So we keep grinding. Okay. Is the strike difference $1 the best? Not necessarily. It's just an example. And look at it this way. If I go to a $5 widespread, $10 widespread, look at it as far as risk reward. You know, if I'm going to go 5 wide, am I able to get a decent return on risk? If I go 10 wide, will I get a return on risk? At some point, you're gonna weigh the pros and cons of how much do I need price to move, right? How much do I need price to move? That's it. Like if I need price to move, then it's like how far does price have to move for you to make money? So I just did $1 wide because it's an easy example, and the return on risk is really simple to calculate. If I went 5 wide or 10 wide, you just do the math. Okay, sounds good. All right, I'll see you in a few minutes. Final hour session, just come right back. See you in a few.